As a long-term fundamental active manager, we often get asked about incorporating ESG. First and foremost, as investors, we look for an attractive investment opportunity. Our value-oriented investment methodology is based on investing in areas we have core research competence in. We value companies based on free cash flow, earnings per share, and private market value. We're looking to invest in businesses that are trading at a discount to what we believe they're worth and where there's also a catalyst to surface value. Environmental, social, and governance issues ultimately can impact financial return. We select stocks based upon our private market value methodology, and we look for a catalyst. As a fundamental equity investor, including other relevant non-financial information or ESG considerations strengthens a fundamental investing framework. Understanding of material ESG issues that may affect a company's intrinsic value are additive to our research and investment process. Governance is one financial area that we have historically considered in our valuation approach. In 1988, we established a Magna Carta of shareholder rights. It helps understand management's commitment to long-term value creation. And there are many other areas within ESG issues that can help to understand a company's value. We have core criteria we examine around governance, disclosure, product safety, product opportunities, supply chain disruption. We consider other ESG criteria depending upon the industry. There are many ESG issues that can be considered. The ability of our research analysts to understand what matters most to a particular industry is very important. Let's consider Johnson Controls, which merged with Tyco. They make automotive batteries, electronics, and HVAC equipment for buildings. This roughly $40 billion company employs 170,000 people across 6 continents. Using materiality guidance, the issues that matter to Johnson Controls are toxic and emission waste produced in manufacturing, health and safety of their workers, and the product opportunity they have to build batteries and HVAC systems that are energy efficient solutions for their customers. ESG lenses would tell you that 5 years ago, the company management set out certain emission reduction targets. Within their industry, they're now believed to have the lowest carbon intensity. They're on track to reduce their own carbon emissions by 25%. They've redesigned their recycling process for batteries and have achieved an 80% recycled capture. Many batteries are now made with over 80% recycled content. Johnson Controls makes the stop-start batteries found increasingly in cars, which are much more fuel efficient. The use of these has estimated to save 660 million gallons of fuel and reduce greenhouse gas emissions by 6 million metric tons per year. As our population grows to 10 billion people amidst constrained natural resources, every investor needs to understand the connection between the ESG issues, risks, and impact on financial metrics. It might be reflected by less waste, a redesigned process, or improved operations. It might be revenue related from a sustainability product. Either might translate into a competitive advantage, increased free cash flow generation, or lower borrowing costs. Some companies are better at adapting to changing externalities. This will ultimately impact their quality of business operations, their own sustainability, and ability to increase long-term shareholder value. Investors should care because environmental, social, and governance issues ultimately can impact financial return. They provide important insights that broaden traditional financial investing to include other risks, opportunities, and examine competitive position.